Welcome! In this video, can Xcn coin rise 34x and make us rich? We will analyze this. Don't forget to subscribe and like, and please watch to the end to understand.
One of the technical chart patterns observed in the market is the descending channel formation, which occurs when price movements fluctuate up and down within a specific range, forming a channel between the upper and lower boundaries. Such structures provide important signals for investors and technical analysts, offering clues about potential future price movements. Let's assume we have such a descending channel structure at hand. In this scenario, the price first touched the upper boundary of the channel, then pulled back toward the midline, and is now showing potential to rise again toward the upper boundary. A descending channel generally indicates that the price has been in a downtrend for a certain period. This channel consists of two parallel lines, the upper band and the lower band. The upper band represents a resistance area where the price often struggles when moving upward. The lower band is seen as the support level, where the price tends to bounce during declines. In the middle of the channel, there is often a median line or average line that determines the direction of the price and where most of the movement takes place. This median line can act as both support and resistance, serving as an important reference point for price action. In this case, we see that the price first touched the upper boundary of the channel, then retraced to the middle of the channel and found support there. This pullback is a normal price movement within a descending channel. When the price rises toward the upper boundary, it can face selling pressure. Increased selling causes the price to retreat toward the median line, which often provides temporary support in a descending channel. Thanks to the support, the price can move upward again from here. At this point, it is quite possible for the price to rise back toward the upper band after taking support from the median line. In a descending channel, when the price approaches the lower band, it is often seen as a buying opportunity leading to an upward reaction. The upper band is an important resistance level for the price, but if the price rises to this level again, it indicates that the current trend within the channel is continuing. This upward movement suggests that the price may attempt to test the upper band once again. For investors and technical analysts, such a pattern is significant because price movements within the channel can give hints about the future direction. If the price takes support from the median line and rises back to the upper band, this can be interpreted as a channel-based reaction move, showing that the price is in a short-term recovery phase. This could be seen as a positive signal for investors looking for buying opportunities. However, there are some important points to consider here. First, it should be remembered that a descending channel generally represents a downtrend. Price movements within the channel may be temporary recoveries, but breaking below the lower band or moving outside the channel could indicate stronger trend reversals. Therefore, a rise to the upper band may not mean that the overall trend has changed. It may just be a temporary rally. Investors should be cautious when assessing this situation. A rise to the upper band can also lead to increased selling pressure, as many investors see this area as resistance and may take profits. If selling is strong, the price could be pulled back down toward the median line or even the lower band of the channel. This means that simply reaching the upper band does not guarantee a sustained upward move. In technical analysis, factors such as volume, momentum, and other indicators should also be considered in these zones. For example, an increase in trading volume during the rise suggests that the price movement is strong and that the rally could continue. Momentum indicators can also be used to determine whether the price is gaining strength. If these indicators support the upward movement toward the upper band, the rise is more likely to be sustained. In summary, we have a descending channel structure, and the price has touched the upper boundary, then pulled back to the median line and found support there. Now the price is showing potential to rise back toward the upper boundary. This movement can be considered a normal fluctuation within the channel, indicating a short-term recovery. However, it's important to remember that the overall trend is still downward, and unless the price breaks out of the channel, the trend has not changed. Investors should consider factors such as volume, momentum, and other technical indicators when monitoring the price's movements within the channel. If the price takes support from the median line and rises to the upper band, this can be viewed positively, as a temporary rally that may create short-term buying opportunities. However, if the price breaks out of the channel or drops below the lower band, different strategies should be considered. That is why price action within a descending channel should be carefully monitored, and investment decisions should be made in light of this technical structure and other indicators. But we cannot decide based on the channel alone. Let's also look at other metrics. Stay tuned.
The ATR indicator is an important tool used in technical analysis to measure volatility. Volatility refers to how much the price of an asset moves within a certain period of time, that is, how much the price fluctuates. ATR quantitatively measures this fluctuation and shows the average true range of the price. In this context, a rising ATR indicates that the magnitude of price movements in the market has increased, meaning volatility is rising. When the ATR indicator rises, it generally means that the price is more volatile, with larger swings. An increase in volatility in the markets indicates the prices can move faster and more sharply, both upward and downward. This can be an important signal for investors because when volatility increases, both risks and opportunities rise. High volatility means that potential gains and losses can be greater. When price volatility increases, the price of the asset moves within wider ranges over shorter time frames. This means that the market may experience sudden price jumps, rapid increases, or sharp declines. When ATR rises, investors realize that uncertainty in the market has increased and prices have become less predictable. Therefore, ATR plays an important role in measuring changing market conditions and in helping traders determine their risk management strategies. Especially during periods of increased volatility, the way the price reacts may change. For example, the price may quickly break through resistance and support levels that it previously could not reach, or it may experience sudden reversals at these levels. A rising ATR shows that there are strong battles between buyers and sellers in the market, and that the market is active and excited. In such cases, prices may make large moves in the short term with sudden increases or declines. Investors should act more cautiously when the ATR rises. This is because as volatility increases, price movements become harder to predict and sudden market moves increase risks. However, this situation also means that opportunities may increase. During periods of high volatility, a favorable environment can form for traders looking to profit from quick price movements. The ATR indicator typically calculates the true range of the price over a certain period. The true range includes not only the difference between the highest and lowest prices of the day, but also the differences between the previous closing price and today's highest and lowest prices. With this comprehensive calculation, ATR objectively shows how volatile the market is. A rising ATR indicates that market volatility has increased and that prices are moving within a wider range. This means that investors need to monitor market behavior more carefully. ATR is especially important for short-term investors and traders in determining position sizes and stop-loss levels. During times of high volatility, wider stop-loss levels may be preferred because the normal movement range of the price has expanded. At the same time, a rising ATR can coincide with periods when the market is excited and important news or developments are influencing it. For example, economic data releases, company earnings reports, and geopolitical developments can all lead to increased volatility. During such periods, ATR rises and price movements become more aggressive. In conclusion, a rising ATR means that price volatility has increased and that the price will move more unpredictably and with greater fluctuations. This represents a market environment where investors must carefully manage their risks and closely monitor the price movements. High volatility carries both great opportunities and significant risks. Therefore, ATR provides valuable insights for investors to understand market conditions, assess risks, and shape their strategies accordingly. The role of ATR in technical analysis is especially critical for making successful trades in volatile markets.
The pennant formation is one of the most important and frequently encountered chart patterns in technical analysis. It generally represents a short-term consolidation period in an asset's price chart and provides strong signals that the prevailing trend is likely to continue. Pennant formations can appear in both uptrends and downtrends, offering investors insights into both entry and exit points. This formation indicates that after a brief pause or a small pullback in price action, the trend will likely regain momentum and continue in its original direction. A pennant formation typically consists of two main components, a flagpole and the pennant itself. The flagpole represents the strong upward or downward move in price that occurred previously. The pennant is the small, narrowing, and consolidating price area that forms after this move, often bounded by small converging trend lines or parallel lines. After the price moves within this narrowing range for a while, it breaks either the upper or lower boundary and resumes its movement in the direction of the main trend. This breakout is the most important signal of the formation and triggers a strong price move. If the price breaks above the upper boundary of the pennant formation, this usually indicates that buyers are dominating the market and the price is likely to move quickly upward. Such a breakout can be a new buying opportunity for investors, and the price movement can increase significantly depending on the length of the flagpole. The target price of the pennant formation is generally equal to the length of the flagpole, which corresponds to the size of the strong price move before the formation began. Therefore, when the price breaks the upper boundary, the expected upward move can be very strong, and depending on the scale of the formation, the price could increase by as much as 34 times. Such large-scale gains are among the strongest signals given by technical analysis and attract investors' attention. The pennant formation can be a precursor to a renewed rally following a period of consolidation in the market. A break above the upper boundary indicates that buyers have taken control of the market and that selling pressure has diminished. After such a breakout, trading volume often increases noticeably, which supports the strength of the price movement. The success of the pennant formation is closely tied to market conditions and investor sentiment. If there is strong buying appetite and generally positive expectations in the market, the upward move after the breakout of the upper boundary can be healthier and more sustainable. In such cases, the price may rise as much as 34x, which represents a significant opportunity for investors. However, as with any formation, the success of the pennant formation is not guaranteed. There is always a possibility of a false breakout, making risk management critical. There are several points investors should consider when using the pennant formation. First, the formation must be correctly identified, meaning the flagpole should be clearly established and the pennant should narrow distinctly. Additionally, the increase in volume at the breakout point enhances the reliability of the price move. A breakout without volume is often a false signal. Furthermore, the market conditions in which the formation appears, the general trend, and macroeconomic factors should also be taken into account. In technical analysis, the pennant formation plays an important role in medium-term investment decisions. The completion of the formation and the price breaking above the upper boundary signal to investors that the price is likely to enter a strong upward trend in the near future. Therefore, tracking such formations enables investors to enter the market at the right time and achieve high returns. The pennant formation also helps in setting stop-loss levels and managing risk. In conclusion, the pennant formation marks an important turning point on price charts. When the price breaks above the upper boundary, this movement often triggers a strong buying wave and suggests that the price could rise by the length of the flagpole. In this case, a potential 34-fold price increase represents an extraordinary opportunity for investors. However, as with all technical signals, careful analysis, risk management, and assessment of market conditions are essential. Successfully tracking and correctly interpreting the pennant formation allows investors to better understand market movements and adapt their strategies accordingly.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments. Analyze the risks correctly and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.